I'll quickly get to the point, which is hearing three experts today. I'll also invite them onto the stage. First up, I'll request Kalpen. Kalpen is a friend, but he's also MD and CEO of DSP Mutual Fund. Probably one of the first few folks I met when I started my wealth management career from the mutual fund side. Kalpen's got 2 decades of experience in client-facing functions, distribution, marketing, and he's dealt with clients all over the country. Thanks so much for joining us, Kalpen. Next up, I have Aashish Somaiyaa. Aashish is also a dear friend. He's incidentally an angel investor in our company. So it's a privilege to have him as an early partner in the company. Aashish is Executive Director and CEO of WhiteOak Asset Management. He's got over 25 years of experience. He doesn't look it. Aashish is the force behind WhiteOak's domestic growth and strategy, and he's previously scaled companies like Motilal Oswal, AMC, and ICICI Prudential. And lastly, my co-founder and partner in crime, Vaibhav. Vaibhav, if I can have you on stage. Vaibhav oversees 11,000 crores of assets at Dezerv, and I think he is a face that you see very, very often in all our webinars and all the series that we do. So we'll get straight to the point and get started. I just want to put things in perspective. This is essentially the largest market drop that we've seen since the COVID pandemic. So if you are surprised about the portfolio value falling, you're not alone. This is something that's happened deep and sharp for the very first time after the last 4 odd years. Now, I'll get to the first question. And I want each one of you to put on your soothsaying hat and tell me, when will these markets recover? Kalpen, why don't you go first?
In 1914, in a similar setup like this, where very accomplished investors were there, and JP Morgan was on the dais, and someone as accomplished like you asked him that, what's your view on the market? When will markets recover? What next? So he closed his eyes for a few minutes. He paused. He was very thoughtful. And he answered in 3 words. Markets will fluctuate. And he said that's the only universal reality in investing. Asset class, they fluctuate. And because we are coming out of a 5-year era of very easy and very lazy returns, I feel that this reality check needed some pin, the so-called bubble in many parts of the market in the world and to some extent in India, needed a pin. And this event ended up being that pin. So as we speak today, in my own portfolios are like 50-50 or 60-40, unclear. I don't know, to be honest. And I don't know if that was an answer which works. I can give you a lot of data points, how much is the tariff, which sectors will be affected, so on and so forth. But honestly, no one knows. We speak to a lot of promoters of companies in healthcare, in auto, in tech, who are likely to be affected. They are saying, we are also waiting and watching. What do we tell you? So I think it's a challenging time in terms of knowing the outcomes. The outcomes have 2 very binary paths, but both the paths will be painful, I feel. This is our house view also. Some will be less painful and one could be more painful and more long-lasting.
I think that's an honest and clear answer. Aashish, going to you, I want to talk about the question behind the question. Most people are worried that their portfolios are down. They are equally concerned about should they continue deploying more money. Is this the right time to incrementally allocate more capital? Because we've always heard that you dollar cost average on the way down. And on that, we are hearing mixed signals from industry experts. So how are you guys seeing this?
Yes, I'll put it first, on a lighter note. What I'll say is that, see, we are not the central character in this. I mean, yes, we are a sideshow, but we are not the central character in this. So, if you go back to school times, and if you saw 2 bullies fighting, you just stand aside and watch, right? You don't have to kind of do anything really, right? And so we are not so important, and we are not the central character right now. So we have to just watch how it shapes up. Now, on your question, I think the most important thing is that how much further down? See, people want to deploy, but when they want to deploy, how fast should you invest? Should you invest over 3 months? Should you invest over 6 months? Because we are not directly impacted. So what is happening? I mean, yes, that's an overstatement. There will be some sectors and some parts which will be impacted. And of course, if US economy, global economy, they are suffering, then we have some collateral damage. But the past history shows that if the world is doing badly, we grow at 5%. If the world is rocking, we grow at 8-9%, right? Plus, there could be some collateral benefits like oil prices, commodity prices, so many other things. So it's a mixed bag for us. Now the point is that in a back-ended fashion, you might actually start gaining some advantage, right? Because like I said, it's two bullies fighting. It's not, we are unfortunately the sideshow in this. Now, so the question becomes that, yes, if foreigners are selling or if equity is being sold because of global turmoil, it's making our markets also cheaper, right? And 70% of the money which comes into India doesn't come directly to India seeking India. It comes in an emerging market fund. So if 65-70% of the money comes to India through an emerging market fund, and because of the turmoil, people want to dump an emerging market fund, for no direct fault of ours, 15-20% goes out from us also. So a lot of the FI selling is not that I wake up saying I want to sell India. A lot of the FI selling over the last couple of years is because of emerging markets issues, and now it will be a lot because of China and all these kinds of things. So if our market is being dumped for reasons which I would dare say are beyond our shores, it is definitely creating opportunity for us. But because we are not able to apply all the past frameworks, we should be wary about just jumping in headlong, right? So the question is, how fast should I invest? I think I should invest, but should I invest over 3 months? Should I invest over 6 months? So my suggestion is that you should invest over like a long drawn period. Like, if you have $100 to add, you will have like a long drawn period of, like say 9 to 12 months. See, normally you tell somebody do a systematic transfer, you say 6 months. But in this, you keep money with you. You drip it over, say, next 12 months, okay? And second thing is, go one level below on your risk grade. So if you are somebody who was going to do small cap, mid cap, you say flexi cap. If you are going to do flexi cap, you say large cap. If you are going to do large cap, you say, a dynamic fund. So reduce your risk grade and go slow.
Every day market is down. I ping Vaibhav, should I put more money? And 9 times out of 10, the answer is no. Vaibhav, how are you seeing the current market correction? Good time to deploy, hold, stay invested? What should we do?
I think that's the most difficult question to answer. You need to be an astrologer to be able to respond to that. Generally speaking, there is a saying in the market that Indian markets always disappoint both the optimist and the pessimist. I think there was too much optimism which was built into the Indian markets till 8 to 9 months ago. Now things have turned to the other side, other extreme. Everyone is pessimistic about the Indian market. There are 2-3 things which are coming out of this trade war which is playing out now. As Aashish beautifully articulated, that two bullies are fighting and we are just standing and seeing. But there is one layer beyond that. We may end up benefiting because of that. There are collateral damages which will be short term. Capital flows will be negative. We will see some outflow of capital from risk assets like equity. But over time, I think there are a lot of collateral benefits. If there is a saying, Dushman ka Dushman dost, in some sense, China is starting to lean towards us and saying that, hey, US is fighting with both of us, and why don't we get together and create something nice as a defense mechanism against that. So that, I think, is starting to play out. US has been much more kinder to us. Third thing which is starting to happen is now US has realized that they also need an ally. So India is benefiting. They are getting proposals from both US as well as from China. So we are in demand, and hopefully once the capital flow issue subsides, there will be a lot of collateral benefit. And I think there is a great opportunity for us to set up manufacturing capacities also. A lot of manufacturing flows which are going to Vietnam and China can start coming to us. Obviously, government will have to do its work. Over next 12 to 24 months, if things remain like this, India will come out of it as a big beneficiary. But over next 3 to 6 months, as Kalpen and Aashish said, very difficult to predict. effectively how Trump is thinking, and everything that we are seeing has a validity of 3 hours till Trump releases the next tweet. So we have to take that into consideration.
So are we then saying that we should deploy in a staggered way over a reasonably long period of time?
Absolutely. Two things: deploy in a staggered manner, slowly. Also be mindful of where you're investing. So domestic businesses, and I was joking with someone, and this is the first thing someone taught me in 2003, 2004. कितना भी बीमार हो, कितना भी गरीब हो, दवाई तो खरीदेगा. So it's that kind of thing. Some of the businesses which will be insulated from this, like healthcare, domestic consumption story, banking and financials, to large extent they will remain insulated. And those are good stories to invest in at this point. Instead of being brave and saying that whatever has fallen more, I'll go and participate in that. There is a general tendency to pick stocks which have fallen the most, but that may not be the right approach. Every environment requires you to reconfigure your portfolio, and maybe there is a time where you reconfigure your portfolio. That's how we are approaching our portfolio approach and our Dezerv equity revival strategy. We are reconfiguring the portfolio to adjust for these changes which have taken place.
Today it seems like, Aashish, that India is like that good student in your analogy who studies hard, works hard, but gets hurt in a bully contest and can't turn up for the exam. Because we saw that in 2019, 2020 when COVID happened. We were coming off a very good run. Fiscal deficit was reducing, we were stabilizing, and then COVID hit. Again, we were on an improving trajectory on all the macros, and suddenly this Trump event has happened. So is there like green or light at the end of this tunnel for India? In the next few months as things settle, do you also see India standing out?
See, I think, if you see outside of the tariff war, let's look at it this way, that in financial year 2025, which just ended, for bulk of 6 to 9 months, there were concerns about India's growth, right? Because first 6 months the government spending, and then so many things happened, rupee depreciation, etc. So we would have wanted a situation whereby RBI takes cognizance of this and changes its policy. And for that to happen, the rupee had to appreciate or stabilize. So from that perspective, if you see, everything that has happened in the last 3 months, at a system level, RBI has moved from negative 3.5 lakh crores to positive liquidity. They've reduced interest rates by 0.5%, and they are saying that going forward, the bias is either not do anything or, if at all, cut the rates, right? So if you leave aside what is happening outside, today's RBI policy, the market should have reacted positively. But that is what happens, when the times are iffy, the good news gets ignored. Right? When times are bullish, the bad news gets ignored. When the times are like this, when things are in a funk, then the good news gets ignored. So that's the state of affairs. And if you really ask me, when you compared 2019-20 and now, see, one thing to keep in mind is that in 2019-20, COVID was a human calamity, there is no doubt about it. But from an economic perspective, it gave us a lease of life, because at that time, the world was booming, we were down in the dumps. So when the world is booming and you are down in the dumps, you cannot flex your policy to prime your growth, because you're busy protecting your currency and busy keeping the deficit low. When COVID happened, it was a race we were losing. When COVID happened, the referee sent everybody to the starting line. All economies went down. So we got the ability to, and then nobody cared about deficit. Then it was just about who bounces back the fastest. So from a macro perspective, COVID was a boon for us because we were counter-cyclical before it happened. Now, today what is happening, again, thankfully we are counter-cyclical. See, the US is going from a period of high growth down, and we are still on a recovery kind of trajectory, barring the blip in the first 6 months. We are actually on a recovery. So thankfully, we are counter-cyclical to what is happening in the world, right? The US has been fighting inflation, whereas we are saying that, okay, it's in control and there is no problem. So I think being counter-cyclical is going to work in our advantage.
And this, I'll start with Vaibhav on this one, is the fact that should we look at fixed income much more seriously? I think the point that was made is that if you were taking a risk level which was this level, you probably need to step down a risk level. And to bridge the gap, maybe fixed income or debt investments is the way to go. How are you seeing the fixed income asset class?
Possibly the best time to look at fixed income and lock in your returns. Rates will go down. Structurally, the inflation gap between India and US is collapsing. So if you look at India's 10-year, which is at 6.5 today, and US 10-year, which is at 4.5, there is a gap of 2% only, which is the narrowest that we have seen in the recent history, which clearly tells us that our inflation situation is much better compared to US inflation situation. This is going to get further boost because of the way commodity prices are collapsing. In some sense, and there are a lot of negatives, but RBI governor must have been thankful that he clearly established that inflation in India will not, Trump clearly established that inflation in India is not going to go up again. And we see downward trajectory, and RBI will take a lot of comfort from the fact that there is no commodity inflation pressure right now, and therefore they will have much higher room to reduce rates. Rates, my view is that rates will be much lower compared to where they are today, and therefore today is the best time to lock in your money in fixed income. One bad thing about last 3-4 years has been that nobody has looked at fixed income. One thing that we constantly heard from all the investors is that why lock in money at 6-7% where we can make 6-7% in a month. So I think moderation of expectation is happening, and asset allocation, which was locked in the closet, will come out of the closet, and people will start looking at asset allocation again. It's a great time to look at fixed income. It will insulate your portfolio from volatility. Plus, there is a tremendous upside to make if interest rates go down from here.
In our careers, Kalpen and Aashish, we've seen mid-teen returns at times in bonds also, right? Where G-Secs rallied because rates came down very sharply. Is something like that can happen where fixed income can give double-digit returns because of rates coming down?
I bought my first small home in Borivali by redeeming a gilt fund. So
a gilt fund is a government bond.
Government bond fund. So between 1999 to 2003, when equity markets were crashing, bond yields also had crashed. And the 10-year government bond in India went down to 485 from a high of 12. So you earn 12% as core carry or coupon, and another 8-9% of capital gains sustainably for 3 years. So 3-year return of government bond funds was 18 to 20% in that era. Now, where are we in the setup today? We are not at 12%. We are at 6% today, 6.4, 6.5. So the starting yield is going to be 6.5. To earn 10%, so on every 1% rate move on a 10-year bond, you earn 7% mark to market. Yeah. So if rates move down from 6.5 to 5.5, you will earn 6.5 plus 7, which is 13.5, minus 1% because the carry will come down again. So 12.5. If you see a 1% rate move, will rates fall by 1%? I don't know. But as Vaibhav said, the direction should be downwards because of all the other positive macro factors. But they definitely can, if you see a 1% move, can give you closer to double-digit returns.
And Aashish, to your mind, then should we deploy in fixed income immediately?
Yeah, I mean, for fixed income, the case would be more immediate. I mean, it's not, typically when economies slow down, typically the tendency is for rates to flag off. So yeah, I mean, fixed income definitely one can consider.
There is a shiny metal called gold, and as Kalpen said, it's outperformed equities in many countries. And when you look at the India chart, it's not very different if you go back a couple of decades. How are investors seeing gold? How are professional investors seeing gold? Are you seeing incremental deployment happening in gold even now?
So I'm seeing professional investors behave like unprofessional investors when it comes to gold. See, typically most investors like past returns. Why do investors not earn future returns? Because they are in love with past returns. And every asset class is cyclical. So even in this chart which you are seeing here, there are long periods where gold has given 0 return. And last year gold is up 40%. Today as we speak, it's up another 4%. Gold's long-term return is 11%. of which 4% has come from dollar depreciation. So its core return is 7. It has no cash flows. But it has been a store of value for centuries, and that is why it has played a very valuable role. I personally have 10 to 15% in gold in my portfolio, so I like that asset class. But we have to be a bit careful after it has moved up by 40%, and the hero asset class, which is generally equity for the long term, is down by 20%. So today people are talking about gold fund. I have seen very large high net worth investors, put 50, 100 crores in gold in the last few days, while the conversations were going on for the last 18 months. So all objective data did not help us convince them that gold makes sense 18 months back. But just one data, that last 1 year return is 40%, moves a lot of people. So we are seeing investors really, chasing gold. Multi-asset funds are getting, huge inflows. Our fastest growing fund is multi-asset, which has 16% between gold and silver. And it has done extremely well because this component has done well, bonds have done well. And so all multi-asset funds would be investing 15-20% in gold. So in that context, there is demand picking up for gold. Whether it is the right decision or not, I don't know. From a timing point, so gold should be a meaningful part of portfolio because of the long-term design. Most emerging markets will see 3% currency loss, 3 to 4% currency loss, including India. That's been the pattern for time immemorial. However much we wish it should change, it will continue to happen. So in that sense, gold plays a great, and secondly, gold kills the volatility of equity. So in this chart alone, if you had added one more line, Sandeep, just the mix of these two, 50-50, rebalanced annually, that new line, let's assume that new line was green in color, it would be higher than gold and Nifty. So by investing in two underlying asset classes, which, it is able to earn higher than them at lower volatility. So gold is important, but you should be watchful because it's run up very sharply in the last 2 years.
So Aashish, I guess what Kalpen is saying, don't look at it as a trader, think of it as an asset allocation. In which case, what's the appropriate asset allocation for gold?
So, first of all, I completely agree with Kalpen that this is a unfair start. There is an endpoint bias. Start point, yeah, the
it's
start
to
point and
provoke a
end
conversation, but I see your point.
Yeah. So, we all have studied in B schools. A lot of people have studied in B schools. So, all of us meaning 25 saal pehle, you studied statistics for management, a book by Levin Rubin, right? तो मैंने book नहीं पढ़ा है, उसका introduction पता है मेरे को. In the preface it says there are 3 types of people in this world: liars, damned liars, and statisticians. तो इसमें थोड़ा सा ये problem है because like he rightly said, gold 40% ऊपर गया and then yeah. So anyway, now so coming to asset allocation, what I meant to say is that, see, there is, when people are investing, there's this concept of clarity and confidence. So, when we are talking that there's so much problem because of US, should we invest or not? So a lot of people will, so I said, धीमे धीमे start करो. And some people will say, नहीं, we'll wait for clarity. तो क्या है कि भाई जब clarity आएगा तो ये भाव भी नहीं रहेगा. So the brownies are for investing when there is no clarity. Second thing is that if people invest amidst lack of clarity, तो जिसके पास 100 करोड़ है ना वो 50 लाख डालेगा. Because there is no clarity, there is no confidence. तो because संदीप ने बोला इसलिए डाला. Now from there it will make good returns. Then there will be clarity and confidence. So Sandeep, when will we get clarity and confidence? That 50 lakh has become 1 crore. फिर 10 करोड़ का चेक आएगा. फिर वहाँ से. So this is a very tough thing that, if you wait for clarity and confidence, so you will get your timing wrong. But then the question is that, bhai, how do I invest without any clarity and confidence? So the answer is the asset allocation. That you have to be in gold also and you have to be in equity also. So, a couple of years back when we were creating a fund, it had 25% gold. So people said, bhai, since time immemorial, gold is $1,800 to an ounce. What are you going to achieve putting 25% in gold? Equity is the place to be in. So I used to tell them, if you're so sure equity is going to be the place, then you put in equity, don't look at this fund. Now, people, like he said, now everybody wants to buy gold. So the point is that asset allocation, on your question, if you're an equity guy, then you stick to equity. Then don't bother about all this. And if you are someone who believes that you should do asset allocation because gold will protect the downside, then you better have 15-20%. Because otherwise also gold is ornamental. If it is 5% of your portfolio, it will yet be ornamental only. Because 5% gold cannot shield you from volatility of 95% equity.
Sure.
So if you have gold, better be 15-20% because it will help. Last thing I want to say about asset allocation is that asset allocation can be done only by people who are open-minded. If you're so sure कि क्या चलने वाला है, तो आप asset allocation कर ही नहीं सकते हो. You cannot do asset allocation with some preconceived notions. It can be done by people who are open-minded. It can be done by people who are probabilistic. See, a lot of us think, if you're somebody who thinks that, who would buy equity in March 2020? In March 2020, the world was supposed to come to an end. We were supposed to be dinosaurs. So everybody was selling. The only guy who would buy in March 2020 would be say, कि भाई, correct है, माहौल खराब लग रहा है, but the history shows that human beings are survivors. तो कुछ ना कुछ तो निकलेगा. So जिसके दिमाग में एक खिड़की खुला है थोड़ा सा, वो ही खरीदेगा when everybody is selling. So that's what I meant. That people who are open-minded, contrarian, probabilistic, they will do asset allocation. People who understand that life is about optimizing and not about maximizing, they will do asset allocation. So अब तो क्या है कि 25% डाउन हो गया, तो अभी asset allocation करके, you don't cut the beta of the portfolio after you lose money. That's the point.
That's right. That's right. Sure.
There's one more category, apart from being open-minded, contrarian, and one more probabilistic, is me, which is confused. Because when I don't know what to do, I do asset allocation.
Vaibhav, for confused folks like me and Kalpen, what is the asset allocation that you recommend? And I know that we are talking at the bottom of or towards the downside of the equity cycle, but in a happy environment.
See, first thing, I think Indian households attract a lot of flag for no reason. They have done remarkably well by holding so much of their wealth in gold. So in some sense, they've been following asset allocation for the longest time. I think gold should be there, but as Kalpen said, at the peak of the cycle, when you will start expecting it to deliver returns immediately, then it will be a problem. Look at it as one asset class which is part of the overall portfolio. When you are looking at multiple scenarios which can play out in the future, you need little bit of everything in the portfolio to make sure that your portfolio doesn't see extreme outcome. What we are trying to protect for is extreme outcome. And when you're cutting down extreme outcome on the downside, you might end up cutting down extreme outcomes on the upside also. But that's what optimization is all about. You don't know what is the best outcome which is there in store for us, so you try and reduce the risk of facing the extreme outcome. So that's how asset allocation should be seen. Whether market is 20% down, 20% up, 50% up, it doesn't matter. Asset allocation should be seen in that light. We are dealing with an uncertain future, and therefore it should be part of the thought process.
We can open it up to a few questions from each one of us. If anybody has a question, please put up your hand.
This is a question regarding sector to invest in right now. So given a choice of doing that SIP that you were advocating for 18 months or back to 26,000, we don't know when it will come, because tomorrow morning we may have some new news which comes up, and day after, and the next hour thereafter. So given two sectors, I will choose, let's say banking as an index or large caps as an index. So which one would you choose, and would you allocate 60, 40, 50, 50 over a 18 months to a 26,000 back period?
So sir, it's I would not bet on any one sector necessarily. I mean, I agree where you're coming from, and I actually agree that banking and financial services, for 2-3 reasons, is a good choice. One, obviously, because all the delta change in terms of fundamentals is in favor for banking and financial services. Second is because large parts of it has underperformed significantly for the last 3 years. Third is, even if, let's say, take NBFC, last 3-4 years, if you talk PSU, railway, defense, infrastructure, those were the things which were working. So if you were called NBFC and you had great performance, you were still underperforming. And now when the market has fallen, asset management, wealth management, everything is down 40-50%, whereas those businesses are not as cyclical as the market makes it out to be. So I understand where you're coming from. BFSI is a great choice. But if you were to put a gun to my head, I would pick only one, which will be a diversified fund. And not get myself stuck with only one particular sector or theme. Secondly, you said that, okay, no, you have to pick two, and what's the proportion? I would still urge you to reconsider that and look at, if it is one fund for this SIP, look at diversified. I'll tell you why. Because even in your diversified fund, chances are that 30% will anyway be banking and financial services, right? So I would actually not do that split between the two. I would stick to a diversified fund. And you said large cap, but I personally feel that in terms of pecking order, large cap, then small cap, then mid cap. Right? So you take an example of flexi cap fund. We are about 65 to 65% large cap. We are 25% in small cap, but in a flexi cap fund, what the regulator calls small cap, that definition doesn't apply. It's a go anywhere fund. So today we might find a lot of value in a 2,000, 5,000, 6,000 crore company, but we may not find value in a 20,000 crore company. We want to do stock picking. So I would always say it should be one fund which is a flexi cap fund where you do this, and don't corner yourself into, don't put yourself into any one corner, crack or crevice of the market. Be in the broad part of the market.
I think there's one more question there.
Yeah, to all the panelists, basically, this question is the very practical questions. For me, when I started my journey with Dezerv, actually, we started with one of my account, actually, and then I increased another one more account. So I can give an example that the first account when I entered in the year of, I think, 2 years back, that account is making good return because most of us are lump sum investors. I'm just putting on the practical questions. So that particular lump sum investments has given a good returns, to be very, with your all insights and everything. But those investments which we have made in last 9 months or something, on the lump sum investments, has not done pretty well. To do as an individual investors, what we are doing, that we are doing a small deployments, staggered deployments as per our own understanding, to at least average it out whatever is going down. Because when we are buying something at 26,000 plus, it is good to buy something, but we don't know in what time frame we should keep on doing this till what. So what is your advice and preferred way in terms of lump sum investors, and how we can able to do that? And a lot of people are talking about multi-asset allocations. Why, how we should do it? Because as we are not having enough time to do all these things, that's why we come to expert peoples like you. So how we will, and when you will introduce multi-assets fund, and how we will able to get advantage of that? Because whatever we have invested, let's say 100 rupees, we want that at least 100 rupees should not go much down as compared to the benchmark, and we should make some alpha over and above that. That's my question.
Vaibhav, clearly, you have to.
So if you invested lump sum about 9 months ago, and maybe it's time to do a top-up, and keep doing top-ups for next 6 to 9 months, and once you finish those top-ups, hopefully markets would have seen much better levels. On multi-asset, we are looking to launch that offering soon enough, and our team will get in touch with you to discuss the details of that strategy.
Thank you, everyone. Dinner is served. We're grateful to the panelists for their insights. We'll continue some of these conversations over dinner, and the bar is also open. Thank you so much.
Thank you.